Chapter 3: Fundamentals of Cost Volume Profit Analysis. We've actually already used CVP analysis in chapters 1 and 2, but in this chapter we're going to explore the concept a little bit deeper. So what is CVP? CVP explores the relations between revenue, cost, volume, and their effect on profits. In prior chapters, we calculated the break-even point, which is profit at zero, depending on the amount of units sold or the amount of revenue earned. And so we didn't know it at the time, but we were already doing CVP analysis. It's just a fancy term for the name of the formula that we've already been using. We know that for a basic income statement, we have total revenues minus total costs equals profit. For CVP, all we do is we take that original formula and we tinker with it. We break down the costs from total costs to variable and fixed costs, and we look at the number of units that we sold, but the overall concept is the same. On this slide, it shows that total revenue is the sales price per unit multiplied by the number of units sold, and total cost is the variable cost per unit times the units of output sold. One thing that I want to mention is you can memorize these little formulas, but what I really want you to do is understand the concepts behind them. A lot of these terms can seem confusing, and to be honest, I don't remember what a lot of these terms mean off the top of my head. I have to look them up myself. But if you give me the data, I can figure out what the question is asking without necessarily having to remember that exact formula that's given in the book. So if you understand the concepts, a lot of these formulas should be common sense. If you read a word problem that says Target sells t-shirts for $10 and they sold 100 t-shirts, what is their total revenue? You can figure that out on your own. You don't have to recall this exact formula because you already know the formula. So again, don't worry so much about memorizing these formulas, but concentrate more on understanding the concepts. Also, for total cost and variable cost, you don't necessarily have to memorize that either. Remember that variable cost is the cost to acquire 1 unit of product. So going back to the t-shirt example with Target, if Target is selling a shirt for $10, they probably didn't buy that shirt for $10. They bought it from the manufacturer for $4. And then they turn around and sell it to the public for $10. So if Target only sold 1 shirt, so for a shirt with a sales price of $10 and a variable cost of $4, then their contribution margin is $6. Remember that contribution margin is the actual amount that is applied to go towards fixed costs, and above and beyond fixed costs would be profit. So don't forget about fixed costs. For a $10 t-shirt, Target might have $6 in contribution margin, but they're going to have to sell quite a few shirts to be able to cover their fixed costs such as rent, manager salaries, electricity, utilities, and other costs. So here's our original income statement formula. Total revenue minus total costs equals profit. They just rearrange the variables. And total costs can be broken down into variable cost and fixed cost. So again, they're taking a formula that we already know and they're rearranging it and breaking it down into different components. On the bottom of the slide, it shows another way to rearrange the variables. Here they have price minus variable cost as one of the components of the formula. So again, going back to the t-shirt example, if the t-shirt is $10, but it costs them $4 to buy it from the manufacturer, then the contribution margin is $6. So a cost accountant might say, I don't really care what the sales price is. I just want to know, what is the contribution margin? How many t-shirts do we need to sell in order to cover fixed costs? So again, all of these formulas essentially boil down to the same information: revenue minus costs equals profit. But depending on what the focus of a certain cost accountant is, that accountant might care more about contribution margin, while another one might focus more on total revenue, and another one might focus more on units of output needed. But it all boils down to the same information. We've discussed contribution margin multiple times already. Again, it's the difference between price and variable cost. So again, with the t-shirt example, if you sell a t-shirt for $10, you have $10 revenue. If the variable cost is $4, meaning you pay the manufacturer $4 for the t-shirt, then your contribution margin is $6. So that contribution margin first is applied to cover fixed costs. So for each t-shirt you sell, you have $6 that you can use to help pay for your rent and utilities and other fixed costs. And above and beyond the fixed cost, now you're going to have operating profit. Here's another example. It's a company called Desert Adventures, and they sell trips or excursions. Last year, they sold 55 trips at $4,000 each, so their revenue is $220,000. But as you now know, that $220,000 isn't $220,000 that goes straight into the owner's pocket. He has a lot of bills to pay. The first thing he needs to pay are the variable costs. For these trips, variable costs might be perhaps he hires a tour guide specifically for each trip. Perhaps he knows the gasoline or fuel costs per trip, tickets per trip, or some other cost per trip that's incurred. So again, he's not getting $220,000 of profit from these trips. He first has to deduct $66,000 in variable costs. So his contribution margin is not $220, it's actually $154. Then he has his fixed costs. His fixed costs might be paying his accounting department, his rent, his utilities. And so his contribution margin is $154. Some people call it gross profit. You deduct the $134.4 in fixed cost, so his operating profit is $19,600. So at first glance, it looks like he's making a lot of money. He made $220,000 in revenue, but after deducting all of the variable costs and fixed costs, he's left with $19,600 in operating profit. Hopefully the owner's salary is part of fixed costs or perhaps a component of variable cost. If not, if his only income is the $19,600 for the year, then that's not really a lot of money. The contribution margin per unit is $154,000 divided by 55 trips equals $2,800. Another way you can do it is you can take your $4,000 sales price, subtract out $900 in variable trip cost, which would give you $3,100, and then subtract out another $300 in other variable costs, which would also give you the $2,800 figure. So again, a lot of these formulas give you the same basic information, and there's also different formulas that you can use to arrive at the same answer. To do a break-even calculation, all we do is set the profit to 0. If profit is 0, then fixed cost divided by the contribution margin equals 0. So we know that the contribution margin is $2,800. We need to know how many trips we have to book in order to cover the $134,400 in fixed cost. So we do the math, 134 divided by 2,800, and we get exactly 48 trips. For this company, the contribution margin ratio would be the $2,800 contribution margin divided by $4,000 in sales per trip. So that gives us 70% contribution margin, which means that for every dollar of sales that we have, 70 cents of that either goes towards fixed costs, or if fixed cost is already covered, then it's 70 cents of profit. If the question asks, how much sales do we need to break even? Well, we know that to break even, we have to cover our fixed cost of $134,400. And if our contribution margin ratio is 70%, then 134,400 divided by 70% means that we have to sell $192,000 worth of trips. Target volume. This is related to target profit. Remember that most businesses are quite expensive to start and to run. Owners often have to put in hundreds of thousands of dollars into a business just to even start it. Sometimes more than that. I think to open a McDonald's cost a minimum of $2 million. And so the owner is going to want to have a minimum level of profit. If you're spending $2 million to open a franchise like a McDonald's, making $5,000 to $10,000 profit in a year is not going to be acceptable. The owner could have taken that $2 million and put it into a simple savings account that pays 1%. Well, that's $20,000 interest right there, and without the headache of running a business. So if the owner is going to spend that money on a franchise, then he's going to want a lot higher profit than that. So there's going to be a target profit to aim for, and related to that is the target volume, the target number of units that need to be sold. So in this case, the company wants to have a profit of $70,000. So the owner wants to know how many trips must be sold. So we already know that to break even, we need to sell enough trips for our contribution margin to be $134,400, which equals our fixed cost. But now we add in the $70,000 profit that the owner wants. So 134.4 plus 70,000, that would be 204. $204,400 divided by $2,800 equals 73 trips. And then we take that 204.4, divide that by 70%, and so our sales dollars is $292,000. And we can check our work because we know that each trip is $4,000, and we multiply that by 73, and we get this figure, 292. So if you like memorizing formulas, you can commit these to memory. The number of units needed to break even is fixed cost divided by the unit contribution margin, which is given in the dollar figure. And if you want the break-even volume in dollars, you take the fixed cost divided by the contribution margin ratio, which is often given in a percentage or in a decimal. And if you're doing the analysis with a target profit in mind, then you just add the target profit amount to the numerators of both of these formulas to calculate the number of units needed to break even plus achieve the target profit. I think of the break-even formula as what is necessary to keep the business running in perpetuity. So as long as a business is breaking even every year, that means that their revenues are high enough to cover all of their fixed costs, so the business can keep running indefinitely. If the business doesn't break even every year, then the business is most likely going to shut down at some point if the owner decides to stop putting in additional money to keep the business afloat. Target volume is useful for a business that is breaking even and making a little bit of profit, so the business isn't necessarily in danger of shutting down due to low revenue, but it can still be in danger of shutting down if the owner decides that the percentage of profit isn't high enough. And this isn't necessarily being greedy. This is trying to make the best use of your assets. And we all do it. If one bank has a savings account that pays 1% interest, and we find another bank that pays 2% interest, I think all of us would change over to that second bank, ceteris paribus, meaning all else equal. Same thing with our jobs. If we have a job that pays us $50,000 and then we find another employer, all else equal, same type of job, same number of hours, but they're going to pay us $70,000, then most of us are going to make that switch. Or even as consumers, we make that decision. If one store is selling a dozen eggs for $3, but we find another store with the same type of eggs selling for $2, we're going to make the switch as well. So business owners make that same type of analysis, perhaps on a bigger scale, but it's still the same concept. So again, if somebody has $2 million, they could either put it in a 1% interest savings account and make $20,000 a year, which is a relatively safe investment. Or if they invest in something riskier like a franchise, like a McDonald's or a gym or some other type of business, they're going to need to get much higher profits than $20,000 to compensate them for the risk, right? If you can make $20,000 interest with your money just sitting there and you don't do anything, or you can take on a business with a lot of headache, stress, liability, and you still only make $20,000, it would obviously be better to park that $2 million into that savings account, which is going to be relatively stress-free. Here's a graph of the break-even analysis that we've been discussing. The dotted line here is your revenue line. As you can see, it starts at 0. If you sell 0 units or 0 trips, you also have $0 in revenue. And the more trips you sell, the higher the revenue you earn. This blue line are your total cost. Remember, total cost includes both fixed cost and variable cost. So in this case, it looks like your fixed cost is going to be $134,400, and so this line starts not at 0, but it starts at $134,400. That means that if you never sell a single trip, you still incur that fixed cost of $134,400. And then for each additional trip that you sell, you incur an additional $1,200 in variable cost. So if you graph those two lines and if you draw your graph accurately, you see that you hit your break-even point here. And this area in between these two lines, above and beyond the break-even point, represents your profit. Next, we're going to discuss two more terms. The first term is cost structure. Cost structure is just a fancy way of saying what's the proportion of fixed cost and variable cost. When someone asks about the cost structure of a company, they're asking about whether its operating leverage is high or low. Which brings us to our next term, operating leverage. But before we talk about operating leverage, we first need to talk about financial leverage and debt. You've probably heard the term leverage before, and that term generally refers to financial leverage. Financial leverage refers to how much debt a business has. So for debt, you can have business debt or personal debt. Personal debt is generally considered bad debt. Personal debt is stuff like credit cards or loans that you use to pay for personal items. Generally stuff like clothes or toys or other personal items that may or may not be essential in your life. It's generally considered bad debt because not only are you going to eventually have to pay for those items, you're also going to incur interest. Business debt, on the other hand, is generally considered good debt. The purpose of a business is to create profit for the owner. And so sometimes if you don't have all of the cash up front to open the business or to buy certain equipment for the business to make money or run more efficiently, then it can be a good thing to use debt to buy that missing equipment or to fund the business to get it off the ground. Also, business debt is tax deductible, which is another factor in why business debt is considered good debt, generally speaking. So again, business debt can be used to help make money for the owner, which would be money that he wouldn't have been able to make at this time because he didn't have the capital to buy that piece of equipment or start the business. But with the debt, he's able to start operating now rather than wait till later. So business debt is generally considered good, but it can still hurt you big time. So leverage generally refers to how much business debt you have. So leverage is an amplifier. It can help you amplify profits. Again, it can help you buy that piece of equipment or start the business now rather than wait till later. So you can start generating profit now. But it can also amplify losses. Lots of businesses fail. So if you put up all of your own money and you had no leverage, then you lose your money, which is not a good thing. But that's all you lose. But if most or all of the money that you invested was not your own money, it was a loan, your business will still have its losses, plus you're going to have to pay the loan back, plus interest on top of that. So it's even worse than just losing your money. So that's the concept of financial leverage. Again, financial leverage is an amplifier. So what about operating leverage? Operating leverage is also a similar concept. But instead of loans versus your own money, it's fixed cost versus variable costs. A company with high operating leverage means that most of their costs are fixed. If most of the costs are fixed, then that means that their contribution margin is pretty high. So that means that for every unit sold, their revenue is almost pure profit. But they do have that tremendously high hurdle to jump over before they get to profitability. That hurdle is the fixed costs. The higher the organization's operating leverage is, the higher the break-even point is. Now, once you get to the break-even point and beyond it, almost every dollar that you make after that is going to be pure profit. But you do have to get to the break-even point first before you can enjoy those profits. We have a low leverage company and a high leverage company. Both companies have a lot of similarities. In this example, both companies sell 1 million units. Both companies sell their units for $1 each. And both companies have the same ending operating profit of $200,000. So at first glance, it looks like both of these companies are very, very similar. But then we take a look at how the costs break down. For the low leverage company, their fixed costs are quite low. Their fixed costs are $50,000. In the high leverage company, their fixed costs are $550,000. So that means that the low leverage company is a lot less risky. All they had to do was sell 200,000 units to cover their fixed costs, and then they were able to start generating operating profit. For the high leverage company, they had to sell 733,334 units before they were able to generate a single penny in operating profit. So the high leverage company was a lot more risky. But the high leverage company has a lot more upside. For every unit that it sells above its break-even point, it's making 75 cents of profit. Whereas for the low leverage company, for every unit sold above break-even point, they're only making 25-cent profit. So if we could accurately predict what future revenues will be, and if we predict that both of these companies will be selling the same amounts in the future, and they'll be selling 1 million units every year, then we can see that it doesn't really matter which cost structure we use, we get the same amount of operating profit. But what if we predict that revenue and the number of units sold are going to increase? So let's say that sales increases by 10% or $100,000. Remember that both companies are beyond their break-even point. But the low leverage company only gets 25 cents in profit for every additional unit sold, whereas the high leverage company gets 75 cents for every additional unit sold. So if our prediction comes true that sales increases by $100,000, then the high leverage company is better off because they are going to make an additional $75,000 in profit, whereas the low leverage company only makes an additional $25,000 in profit. If we predict that we can easily overcome the break-even point for either company, and we predict that sales is going to continue to increase, then perhaps high leverage is the better way to go. But if we predict that sales might fall, or if the owner is risk averse, he doesn't really like a lot of risk, and he's fine with 25% profit because it's safer, then maybe the low leverage cost structure is better in this scenario. So there are a lot of factors to consider when deciding which cost structure to go with. One real life example that I can give you is that I used to own a small gym. I owned an Anytime Fitness out in Alief, Texas. And I bought it from an owner who had some medical issues. The gym was pretty new. It was only about a year old. It wasn't profiting, but I did calculations and I figured that if I could increase the number of members of the gym even slightly every month, then I could achieve profitability in a few months. So do you think a gym is a high leverage type of business or a low leverage type of business? Well, a gym is generally considered high leverage. You have a lot of fixed costs. You have your rent and your utilities, your equipment, and those are a lot to overcome. Now, the upside is that contribution margin is pretty high. For every member that signs up with your gym, that's almost pure profit. You do have some variable costs because the member is probably going to use some paper towels, some soap, and maybe your AC bill is going to go up a little bit. But most of the revenue that you get per member is going to be either pure profit or go straight to fixed costs. Now, unfortunately, when I bought the gym, as I said, it wasn't at break-even point yet, and I did my calculations, and I figured that I could get to break-even point within a few months. But unfortunately, not only did membership not grow, but it actually shrank a little bit. So I was never able to overcome those high fixed costs, and then I ended up having to sell the gym myself after about 13 months. And I lost quite a bit of money on that gym. So I learned that every business is risky, especially when the cost structure has high operating leverage. So if I ever try another business, I'll probably go with a business with a lot lower fixed costs. So even though a low leverage type of business has a lot less potential, it's also a lot less risky. Margin of safety. That term is pretty self-explanatory. It's the excess of sales over break-even sales. So in this example, Desert Adventures usually sells 55 trips. We calculate that we really only need 48 trips to break even. So 55 minus 48 means that we have a margin of safety of 7 trips. So even if next year the number of trips goes down by 10%, which would be 5 trips, we're still making money. So we might consider this a relatively safe business to invest in if we were to do so. Microsoft Excel can be used to do these CVP analyses. If you know how to do this, you can definitely use this on your homework, or if you just want to play around with Excel and plug in numbers into your homework, that's fine as well. We're not going to cover this on the test, but if you do get into cost accounting after you graduate, this would be a good tool to be familiar with. The goal seek function in Excel is pretty handy. You can plug in your target profit and say, well, to break even, how many trips do I need to make? And so you would tell Excel to adjust a certain cell accordingly. In this case, we're having them adjust the volume cell. And so the computer will calculate the number of trips that you need to attain a certain level of profit. Another concept that we're not going to test, but that you should be familiar with, is taxes. In the prior examples, we didn't deal with tax, but in this one, it says that Desert Adventures wants to generate after-tax profits of $25,200, and it tells us that the tax rate is 25%. So to calculate that, we do 1 minus the tax rate. So 1 minus 0.25 equals 0.75. And so we do 25,200, which is our after-tax profit. We divide that by 0.75. And so our before-tax profit that we're going to aim for is 33,600. Again, you don't need to know how to do this for the test, but you should be familiar with the concept. Now, one concept that you do need to be familiar with and know for the test is multi-product analysis. So in the prior examples, we've had one product or one service with one price. So our calculations were fairly easy. But now we're adding a curveball. Now we're going to sell 2 items. In this case, we're going to do excursion trips and also rafting trips. So not only do these trips have different sales prices, excursions are $4,000 and rafting is $500. We're also going to have different variable costs, and we're not going to sell the same number of excursions and rafting. We're going to sell 25% of our as excursions, and 75% of our trips will be rafting trips. And also, let's see what our contribution margin percentage is per type of trip. So if we're making $2,800 contribution margin for an excursion, and the sales price for an excursion is $4,000, that's a 70% contribution margin. And for rafting, our contribution is $400 divided by the $500 sales price. And so for rafting, our contribution margin is 80%. So we actually make more profit percentage-wise on the rafting trips, although dollar-wise, we make more on an excursion. The fact pattern also tells us that total fixed cost is $144,000. So these are a lot of variables to juggle. We have to know not only how much profit we make per type of trip, but we also have to consider that we sell way more rafting trips than we sell of excursions. So first we're going to calculate the contribution margin overall. Remember that for excursions we make 70% contribution margin, and for rafting we make 80% contribution margin. And the dollar amount for rafting contribution margin is $400 compared to $2,800 for excursions. So assuming that we sell 100 trips, 25 of those trips are going to be excursions, and 75 trips are going to be rafting. So 25 times 2,800 is going to be $70,000. 75 trips times 400 is going to be $30,000 for a total contribution margin of $100,000. And what is the weighted average contribution margin of the mix? So 25% of our trips are excursions, where we make $2,800, and 75% of our trips are going to be rafting, where we make $400. So that's going to be $700 plus $300, which gives us $1,000. So on average, every trip sold, we're going to make $1,000 contribution margin. So when we sell an excursion, we're going to make $2,800. When we sell a rafting trip, we're going to make $400. Average together, we're going to make $1,000 per trip. So what is the break-even number of units for the mix? Well, we know that fixed cost is $144,000, and our average contribution margin is $1,000. So 144,000 divided by 1,000 equals 144 units. 75% of the trips that we sell are rafting. So when we do 144 times 75%, we get 108 rafting trips, and 25% times 144 is 36 excursion trips. And if we want to know the total revenue instead of the number of trips, we can multiply 36 times the $4,000 sales price per excursion, and then 108 times the $500 sales price for rafting, to give us a grand total of $198,000 in revenue. For weighted average revenue, we just apply the percentage of the number of trips of excursions times the excursion sales price, and we add that to the percentage of rafting trips times the rafting sales price. So for every trip that we sell, on average, we're going to increase our revenue by 1,375. And what about the weighted average contribution margin percentage? Remember that we make 70% contribution margin for excursions and 80% on rafting. So we know that when we do the weighted average, our number has to be somewhere between 70 and 80%. So again, this is an important test-taking skill to have. If your two categories give you 70% and 80% contribution margin, and you have to average them together, then your figure has to be somewhere between 70 or 80. So if you're doing homework or a test and it's a multiple choice, you can immediately cross out any numbers that are 70% and below or 80% and higher. You know that the answer has to be somewhere in between. And a lot of times that'll get you the right answer without even having to do any math. But if you do have to do the math, it's our $1,000 average contribution margin divided by our $1,375 in average revenue, which gives us a 72.72% contribution margin percentage. And once we have that percentage, we can take our fixed cost divided by our weighted average contribution margin to arrive at the total amount of revenue that we have to generate to break even. So why do we have to generate $198,000 of revenue when our fixed costs are only $144,000? Well, again, don't forget about variable costs. Remember that for every $10 shirt that Target sells, they have to buy it from a manufacturer for $4. So we don't just compare total revenue to figure out the break-even amount. We have to consider the variable cost, which is part of the contribution margin calculation. So this is the end of the Chapter 3 lecture. Next will be the Chapter 3 homework solutions. Don't forget to try to work out the homework solutions on your own before watching the video.